Hi, this is Phil Greenwood again, and this is our second in a series of podcasts for Craft Beer Finance. This section, a short section, we want to talk about what we call managing for liquidity, which really means we're beginning to look at ways we can use the balance sheet and income statement to help us manage our cash flow. Really pretty much paying our bills. So what we're going to do is present a balance sheet and a mechanism by which you can rearrange the balance sheet to make them a little more sense so that you can analyze, the liquidity, and then to begin to not only analyze but develop techniques to become a little more efficient in managing your operations. So here we've got a financial statement, a balance sheet for a craft beer distributor. We'll exclude the name. We'll call it WS Distributor. And you can see it has 3 years of balance sheet information, 2012, 2013, and 14. The company has a little bit of cash on hand. We'll assume that this is rounding to thousands. Accounts receivable, inventories. You see a new account called prepaid expenses. These are things like insurance, where you pay the premium at the beginning of the year, and that prepaid amount, because you haven't actually utilized the premium as an expense, it goes on as an asset, and then it goes down each month by the amount of the premium used up. Current assets, then you see down below non-current assets, financial assets, and intangibles, and then also some property, plant, and equipment, listing both the gross value, what it was originally purchased and put on the books for, and then the depreciation that's been accumulated over time, leading up to the total assets. In total, it doesn't look like any major changes. The numbers increase a little bit. Inventory, I think you can see, goes up some. But what we want to do is be able to take this part of the balance sheet and also the second part, the liabilities and equity, and begin to put it in a different format so we can make more sense of, do we really have enough assets on hand, cash on hand to pay our bills and to also fund the long-term operations. When we look at the second part of the balance sheet, you can see the liabilities includes a line of credit with the bank. That number increases a little bit each year. The current portion of long-term debt, typically that would be the principal on a loan that has to be paid off for that next 12 months. There you see the payables, what we owe to vendors, increases somewhat. And then there's a small account called accrued expenses. Usually accrued expenses are short-term obligations, what we'll owe to employees at the end of the month or end of the 2 weeks, taxes we may owe, things of that nature. And then down below, the non-current liabilities, in other words, long-term debt, we won't have to pay off the principal until greater than a year's time, and then shareholders' equity and so on. As you can see, kind of like the assets, numbers increase a little bit, but not dramatically. Couple things to note is when you look at it, the format, and this is a format that's traditionally developed by generally accepted accounting principles. It may make sense for financial people, and it does make sense in that it shows the books are in balance, that total liability and equity equals assets. But it doesn't give you a great deal of information about, do we have enough capital on hand to cover the operations, both short-term and long-term. So what we want to do is help develop what we call the Managerial Balance Sheet. And what we're going to do is take those same numbers from the original balance sheet and rearrange them. We're going to create 2 categories. Instead of assets versus liabilities and equity, we're going to create a category called invested capital. That's going to include cash. It's going to include a category we'll call working capital required, which will show a little bit what that means in a second. Working capital required is typically current assets and current liabilities excluding cash, and then net fixed assets. These will be the 3 major items when added together, saying this is the amount of money we have put and is sunk into the business. We got to make sure we've got enough to cover that, as well as that we want to match our short-term capital with our long-term capital needs. The second category is capital employed. That's pretty much going to include short-term debt, as we said, like that line of credit and the current principal portion we pay on the bank principal, and then any long-term debt, including bonds, leases, and so on, plus our equity. And so ultimately, when we take those numbers from the previous balance sheet, recategorize them, rearrange them, we want to come up with a more simple, or I think a more understandable equation where we say the capital employed that debt and equity, should equal our invested capital. So when we take that previous balance sheet and rearrange it into our distributor management balance sheet, you can see the company, for instance, in 2012 has $121,000 of invested capital, cash, working capital required, and net fixed assets. The working capital required, again, is going to be the current assets, excluding cash, minus what we call any non-debt current liabilities. In other words, the accounts payable and the accrued expenses. So in 2012, we've got $121,000, and in 2012, we have capital employed of $121,000. A couple of things we want to note. Ultimately, you want to get to a point where your short-term debt is primarily used to finance your cash and your working capital required, and the long-term financing, which includes long-term debt and equity, is primarily used to finance the fixed assets. When those numbers get a little out of balance, that can lead to some issues over time. And then as you see over each year, 2013, 2014, the invested capital increases, and we have plenty of capital employed to cover that. But you'll notice our short-term debt, it increases quite a bit from 12 to 13, but we keep it pretty stable for 2014. Yet our working capital requirement goes up by $14,000 between 2013 and 2014. We had to make up for that shortfall, in other words, not having enough short-term debt, by either getting more long-term bank loans, long-term debt, or increasing our equity. Another way to look at this is we can then begin to take our invested capital components and our capital employed components and take each category and divide it by the total for each category. For instance, in 2012, we can see our cash at $6,000 divided by the total invested capital is roughly 5%. That number goes up to 9.5%, but then goes back down to 5.8% in 2014. On the other hand, the fixed assets, the net fixed assets, are at 46.3% in the oldest year, 2012. That decreases to 38.4%. Now there could be a lot of questions that could range from that, but one thing that might signify is that maybe we're not buying any new fixed assets, which may be fine, but and we're just letting them depreciate, but maybe it's kind of symbolizing the company's not spending enough money on reinvesting in its property, plant, and equipment. Down below, you can see in the capital employed, our short-term debt as a percentage actually increases, the percentage of total. Long-term financing goes down, and shareholders' equity as a percentage of total increases quite a bit to 2013 and kind of stays the same at 2014. So as time goes on, a company might want to set particular goals that we want our cash to be a certain percentage of total invested capital, or at least monitor these percentages to know that they are changing, ask why they're changing, and maybe we have to take some action in order to maintain things.